Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, everybody, and it's October 5th. We got a few economic news releases to go over today, and actually, these are the big ones for this week. It's the job numbers. So let's jump right into it. We'll start off the non-farm payrolls for the month of September. These are brought to you by the Bureau of Labor Statistics, or BLS. The previous month, we had 270,000 back in August, 270,000 new job creations. Forecast for this month was 168, and it's disappointing at 134,000. But if you look at the previous 2 months, they had revisions upwards of 87,000 jobs. So if you factor another 87,000 on top of this, we're well more than that. So this is actually, even, and on top of that, we also had Hurricane Florence last month. So that could also play a factor into this as well. But with the revisions, it's great numbers. Headline number itself, yeah, disappointing. But when you take into account the revisions of 87,000 new jobs, it's fantastic. Now, also take a look here at the unemployment rate for the month of September. We had back in August at 3.9, which is still phenomenal. The forecast was supposed to drop a little bit to 3.8, and it dropped way down to 3.7. We haven't seen this since 1969, the 3.7 unemployment rate. Now, a lot of that had to do with if you break down the surveys and stuff like that, we had about way more job openings created and fewer people. We had more people. The ratio between job creations and people coming to the market, new fresh blood into the market, basically, that's what lowered it. And then last but not least, we got the average hourly earnings for the month of September. So we kept on the same pace as you can see here. We had a 0.3% in August. Forecast supposed to be 0.3, and it continued that same pace at 0.3%. Now, this has investors a bit concerned because that brings our year-over-year average hourly earnings up to 2.8%. As we've been saying for quite some time here, the labor market is tightening up a bit. As you can see, with the job openings out there available, we have a lower participation rate. We got, we have the number one concern for small businesses is basically trying to find the skilled laborers to meet their criteria, and that's the number one concern that they have. There's more jobs available than we have people looking for jobs, and our initial jobless claims are dwindling lower and lower, and we're at all-time like 50-year lows on those as well. So that's the concern. They're concerned about the inflation. And we'll touch on that here in a bit. Stock market is down as a result of that. Again, that just basically means that if inflation is ticking up, that means the Fed's going to continue with their rate hikes here. And of course, that's kind of stunting the stock market from growing too much. We do got pretty much all week we've had Fed members speaking, so today's no different. We got a few more members speaking. So far, we haven't had any that jumped out at us that really kind of disrupted the markets. But again, it's always that possibility that we could get somebody out there that could make a comment that could surprise the markets and change things. So let's take a look here at the bond market. Bond market continues its downward trend, and it's pretty much tanking. This floor support now is dropping further down, so we're trying to catch a little breather at the next floor support, and basically down about 23 basis points, which, yes, so we got worse pricing, did worse on rates. So basically, rates will go up at least another 8% in the rate. So again, continue to decline here. And then yields here continues to rise. We're up to about 3.22. We're fighting this resistance, overhead resistance. If hopefully this can hold, if this can contain us, it will help the bond yield or bonds find some type of flooring to kind of get a little push off and help us get back upwards and improve a little bit, take a little bit of a breather. But yields are also a concern to investors as well, because with the higher rate of yields, some investors may look at that as a good enough rate of return on their money and still be safe and liquid, where they don't have to worry about the volatility of the equities. So they may pull money from the equities market into buying these in higher yields. And of course, again, that's kind of what's affecting the markets as well. All right, so that pretty much wraps things up. Our rates are a little higher today as a result of the possible inflation talk on the average hourly earnings. If you guys want to get any other, if you want to get more data throughout the day, just come over to Twitter. You can find me at Mike Bjork, as I do post market changes on there as well. If there's any market changes, go to Twitter. That's where I post. All right, you guys have a great day, great weekend. We'll look forward to see you guys on Monday. Thanks for watching. Bye bye.